What's up, everybody? This is Erin with Term Insurance Brokers, and I'm here to answer your life insurance questions. When most people think about life insurance, they only think about covering the breadwinner, but they're missing something really important, and that's covering their spouse. Let's say you're the primary source of income in your family, and you have 2 young kids at home that your spouse takes care of full time. Have you thought about what your plan is if something were to happen to your non-working spouse? What would happen with your kids? Would you need to reduce your hours at work? Hire a nanny? Quit working altogether? Most people think of life insurance as an income replacement, but not as a time and effort replacement. Having a policy on your non-working spouse can save you a lot of unneeded heartache during an already difficult time. It can provide you the luxury of not having immediately to go back to work, and it can also provide money to take care of your children. So a natural follow-up question to that is, how much coverage should my non-working spouse have? For most families with young kids, we would suggest a minimum of $250,000 for a non-working spouse. A bit more of a realistic number would be about $500,000 to $1 million, but having some coverage is better than having none. While a non-working spouse needs at least that much coverage, a working spouse might need even more, as there's a loss of income that you need to account for in the event of their death. Typically, the maximum amount a non-working spouse can get would be half the benefit amount of what their working spouse either has in force or what they're applying for. If they're working, the amount of coverage they can get will be limited to a multiplier of their income that's dependent upon their age, or half the breadwinner's coverage amount, whichever is greater. Now let's look at an example. A 35-year-old woman that's earning $40,000 a year, and she's in great health, and her husband makes $150,000 a year. They both want to apply for $1 million. But because the maximum income multiplier for a woman her age is 30 times her income, they can both apply for the $1 million in this scenario. Now, if she was not working, the maximum she could apply for would be $500,000. Now let's look at another example. We have a 55-year-old woman in the exact same scenario with the exact same income. Now, based on her age, the max multiplier of her income is 10 times. So the max she would be able to get is $400,000 based on her income alone. But since her spouse is applying for $1 million, she could get $500,000. If her husband did not have at least $1 million total in force or applied for, she'd be limited to $400,000. So naturally, the next question is, how much is this going to cost? And the answer can be surprisingly low, especially if you're young and healthy. A 35-year-old can get a 20-year, $500,000 policy for as little as $18 to $20 a month. And a 45-year-old can get a 20-year, $500,000 policy for as little as $38 to $46 a month. Okay, well, that's it for me today. If you have any follow-up questions, be sure to comment below. If you want a free, no obligation quote, you can call me directly at 702-622-7352. That's 702-622-7352, or you can visit our website at terminsurancebrokers.com. Don't forget to follow us on social media, on Instagram at Get Insurance Now, on Facebook at Term Insurance Brokers, and please remember to like this video and subscribe to our channel. Make sure you click that bell so you're notified when all our new videos come out. See you guys next time. Bye!